Good afternoon, everyone, and thank you very much to the Schiller Institute to giving me the opportunity to deliver this speech about the situation of the European Union and of the European financial system. Briefly, before assessing the status of the European economy and financial system, let me say a couple of words on what happened on Friday. So the surprising result of the UK referendum on the membership to the European Union. As I say, the result was surprising and, in my view, was a very strong message of democracy to the European Union and to the European institution. European Union ignored the willingness of people and citizens in forcing a political integration that is not the right way for Europe to cooperate. I remember referendums in 2005 about the European Constitution that were blocked by France and the Netherlands, and I remember in 2008 the referendum in Ireland about the Lisbon Treaty. European institutions decided to ignore the voice of citizens, and the Brexit is the result of this lack of political view for a united Europe with a cooperation between European countries. I think that this is a huge opportunity for European countries to sitting all together around the table, assessing and declaring the failure of this project of the European Union, and try to set up all together a new project, an alternative project for Europe, because Europe is different from the European Union, and I'm a strong supporter of Europe and of European citizens. And as I was saying, try to create an alternative project for Europe that will restore economic growth in Europe, that will respect the difference that European countries have, and in a framework of real cooperation, so an Europe focused on the real needs of the economy, of the real economy, of SMEs, of citizens, not an Europe based on the needs of speculation, of finance, and on the big banks, as this European Union is doing. And I received a very good news just an hour ago. The European Commissioner responsible for financial regulation, former lobbyist in Brussels for the financial system, Mr. Jonathan Hill, resigned due to the Brexit. So this is a good news. Let's hope that we can work better in the economic and monetary affairs inside the European Parliament. Having said that, now I will try to assess and to present the status of the European financial system. As this sentence points out very well, the European financial system is collapsing. It's collapsing because of wrong policies bringing out by the European government and by the European Union. After the financial crisis in 2008, the European Union decided to focus on the wrong problems. So they tried to set up financial regulation focused on trying to overcome the consequences of a crisis. In my view, this is not the right way in order to restore and in order to guarantee the stability of the financial system. if we want a banking system, a financial system that is safe, if we want financial stability, we should focus regulation on preventing crisis, preventing financial crisis. Working and regulating the liability and equity side of banks is not the right way, in my view. We have to focus on the asset side, on the exposure of the financial system to certain type of financial assets. And in this way, and in this task, the European Union failed, and the project of the banking union failed. Let me talk about the first pillar of the banking union, that is a single supervisory mechanism for all the banking union participating member states, for all the banking system of those member states. The approach of the single supervision delivered by the ECB or by a branch of the ECB is completely wrong. And the evidence of this is the stress tests, the stress tests presented by the ECB after November 2014. The mistake in the analysis and in the approach of the ECB is that they assess only the credit risk present in the balance sheet of the European banking system. They completely failed in assessing the exposure to problematic, to speculative financial assets that are present in the balance sheet of the banking system. I'm talking about what we call, and the regulation calls, level 3 assets. Level 3 assets are financial assets that are illiquid. So the price and the number that is in the balance sheet, in the asset side of a bank, is decided by internal model prepared by the same banks that has the interest in setting a certain number for the value of this asset. The single supervisory mechanism decided to not assess and to not consider the risk related to the level 3 asset, to derivatives exposure of the European banking system. And this is a huge mistake that is threatening the stability of the European banking system. According to the stress test and analysis of the ECB on the European banking system, a bank as Intesa Sanpaolo, one of the most important Italian banks that has problems. I know that Intesa Sanpaolo has problems in the NPL side, non-performing loan side, in the credit risk side. But Intesa Sanpaolo has 80% of its assets related to credit, related to the real economy, and just 20% of its exposure related to speculative financial instruments, to trading, and so on. According to the ECB, this bank is riskier than, for example, Deutsche Bank or BNP Paribas. But looking at the balance sheet of Deutsche Bank and BNP Paribas, the proportion in the asset side is completely opposite. They have exposure for 80% of the assets to level 3 assets, to derivatives, to speculative instruments, to trading assets, and just 20% of the asset dedicated to the real economy. So I think that a system that is considering riskier Intesa Sanpaolo rather than Deutsche Bank or BNP Paribas is completely wrong and is threatening the stability of the European Union, of European countries, and of the European financial system. The single supervisory mechanism is unequal because it's failing in assessing the market risk and also the legal risk inside the balance sheet of banks, because all those too big to fail banks, all those speculative banks are facing billionaire causes due to their behavior on the financial markets. They manipulated the exchange rate markets, they manipulated the interest rate markets, and they are facing billionaire bills and fines of billions could threaten the stability of banking balance sheets. And the European Central Bank is failing in assessing this risk deliberately. This is a political decision. Looking at what is happening in the Italian banking system is the evidence of the iniquity of this approach. Italian banks have problems related to their exposure to non-performing loans, but it is, I say usually, a euro-inducted crisis, because if your economy shrinks, if your SMEs go bankruptcy, if your homeowners cannot pay borrowings, cannot pay mortgages, clearly the banking system will suffer from a huge exposure to NPL. If your economy is not performing good, is not performing well, you will experience problem in the credit market and problems related to the NPL. Now, as I said, this crisis, this problem is related to the euro, in my view, because the single currency is creating huge macroeconomic imbalances between European countries. The Eurozone is not an optimal currency area, and I think that due to political constraints and due to huge differences between Eurozone countries, we cannot fix this Eurozone, this currency union. So this is the problem related to the euro. What about the policies that the European Union is trying to set up in order to make the financial system safer, more stable? It's all related to a more financialization of the system. Just an example on a policy proposed by the former Commissioner to Financial Regulation. They think that if we need to restore growth in the European Union, we have to revive securitization. So the proposal that now is on the table of the European Union, of the European Parliament, is a framework for single, transparent, and standardized securitization that is meaningless, because looking at the proposal, there is nothing simple, nothing transparent, and nothing standardized about securitization. If you use synthetic securitization, if you use derivatives, CDOs, there is no simple securitization, and securitization is not the means to restore funding for the real economy. So about our proposal in the European Parliament and in Italy to restore growth and to restore the stability of the financial system. Clearly a first step, and we proposed one bill in the Italian Parliament and one in the European Parliament in the framework of the banking structural reform, is restoring banking separation. We think that we have to set up a sort of modern European Glass-Steagall that will simplify the regulation on the banking system and will make the separation between the core, the part of a bank and a speculative bank, in order to create a banking system that is no more focused on speculation on the financial system, but on the needs of the real economy, on the needs of people. And this is the first step. The second step is a proposal related to one of the most problematic banks in the European Union, that is Monte dei Paschi di Siena. I think that you all know the situation of the third Italian bank and the oldest bank in Europe, because Monte dei Paschi di Siena was founded in the 15th century and operated throughout the centuries in order to support the real economy. Now we have the opportunity, the Italian government has the opportunity to take over this bank that is really in trouble, and to make this bank an example, a real example of what could be a banking system focused on real economy. So what we are proposing is to nationalize Banca Monte dei Paschi di Siena. The Italian Treasury is the first shareholder of this bank with a 4% stake in Monte dei Paschi, and to set up a clear mission for Monte dei Paschi di Siena in order to have this bank clearly focused on the needs on real economy. We will not allow Monte dei Paschi to operate in trading business, to operate in the derivative business, but the mission of Monte dei Paschi will be just to operate as a public service for credit in order to support the real economy. I think that this proposal could be a benchmark for Europe, for the European banking system. We had to do more in the European Parliament, and I hope that after Mr. Hill, we are able to talk again about the banking structural reform and the European Glass-Steagall that this lobbyist blocked after being elected commissioner, and then go on with a project of Europe that will overcome this failure of the European Union and will bring Europe again at the center of the global scenario as connection between the United States and Asia. I think that this is a good way for Europe to restore growth, to restore democracy, and to take the role that European citizens and European people should have in the global scenario. Thank you very much.